Hello and welcome to part 6 of our video series. Today we'll be looking at what kinds of tax aid is available for parents and or students for college. Our company is the College Funding Connection. You'll see our contact information just below, and our website is collegefc.com. Now we could start out by looking at a planning model, and if you've seen previous videos that we've done, you'll know that we refer back to this a lot because it's so important to start with a good plan. And at the top section, we've covered this in previous videos, the college selection process, which really focuses in on the student and the important parts of selecting a list of relevant colleges or universities. The second part is the financial aid estimate or assessment process, and this covers merit aid, need-based aid, and again, very important to understand those numbers before you get too far along in the college planning process. We can then look at or talk about personal resources. Not going to cover that today. How do you budget for college? How much is affordable for your family? But today we're really going to focus in on tax aid, tax credits, income shifting, and then investing, and how you can maybe get into some unique planning strategies there as well. Now, before we get too far along in the video today, wanted to stress that our company is not a tax planning firm. So don't want anybody taking this information. I'm sure you've heard the saying, a little information can be a dangerous thing. But we don't want to take this information and then go ahead and create your own personal tax plan if you don't really understand the process. So do consult with a qualified tax professional to help you with some of these issues. We can help with some with the financial aid planning, but you need a tax planner or somebody that understands that process as you get into filing and planning for taxes. So as far as the tax benefits, wanted to cover a couple of the new rules and tax credits. The first one is the American Opportunity Tax Credit. And it's really quite a valuable thing if your family qualifies for it. It's worth up to a $2,500 credit. And what I like about this in particular is that it's a per student credit. We often work with families that actually have more than one student in college simultaneously. So it is per student and per year, and it actually covers the freshman through the senior years of college. Now, if you're in a higher income bracket, you may not qualify. So we want to make sure that everybody understands the phase outs. And a phase out means that the higher your income, the lower the credit. So the phase out begins at $160,000 in income up to $180,000 of married adjusted gross income. So if you're married filing jointly, this would apply to you. 100% of the first $2,000 of tuition, fees, and books is covered, and then 25% of the next $2,000. So it's a significant credit, and you want to make sure you're capturing that and taking advantage of that if you do qualify. Now, just below, you'll see a note that the Lifetime Learning Tax Credit still exists, as well as the Hope Credit. So those haven't gone away. We won't cover those today because they've been around for a while, but you'll want to research that or talk to your tax planner about those as well. Now, the second part is the tuition and fees tax or income tax deduction. So it's worth up to a $4,000 deduction. So again, pretty significant if you qualify. Now, keep in mind again, though, that there are phase outs, income phase outs to qualify for the deduction. And it does cover tuition and fees. But if you make 0 to 130,000 in adjusted gross income, that could equal a $4,000 deduction. 130 to 160 could be a $2,000 deduction. Anything over 160, then the deduction would phase out completely. So again, understand the rules, but talk with a qualified tax professional to see if you do qualify. Now, when we talk about income shifting, I want to be clear that each strategy that we talk about is relevant for a specific group. So here is one where if you're a higher income earner, you don't think you're going to qualify, or you may know already that you're not going to qualify for need-based aid or merit-based aid at the college that your student has selected. So here's one idea, income shifting, where if you are a business owner, you can shift income. Instead of paying yourself, basically you pay your kid or your kids, because they oftentimes fall into a much lower tax bracket. So it's a way to provide some income for them, reduce your tax obligation in the process, but at the same time provide money for them to use to pay for college. So this is not for everybody, but if you are a business owner and you know you're not going to qualify for need-based financial aid especially, this is one idea for you. Another one is shifting unearned income. So you can gift appreciated assets, and especially income-producing assets, and in that way, you're basically shifting that income or the assets again to a lower tax bracket with your child. So earned income, like we've talked about, which is wages and earnings. The other part of this, though, is unearned income. So this would include dividends, interest, capital gains. So if you have investments, especially if they've grown over time, this is one idea to shift some of those assets over to a student. Now, again, we always stress qualifying or investigating need-based financial aid first. I can't tell you how many times I've met with a family. They had a well-intentioned accountant or tax planner that was working with them to shift income and assets over to their child, and then they went to apply for financial aid and found out that they didn't qualify for anything because the assessment on student income and assets is very high. So you want to first check the need-based aid eligibility before you get into some of these tax planning strategies, because you could find that the tax benefit that you get is minuscule compared to the financial aid that you just gave up because of that particular tax planning strategy. So it does require an understanding of both, and you want to make sure that you're sharing that with your accountant, and your accountant is working with a qualified financial aid professional to make sure that both plans are in sync with one another. Now, I wanted to cover the Kiddie Tax Rules just briefly, but the Kiddie Tax Rules now apply to children under the age of 19 and college students. So if you have a child in college, they still qualify from ages 18 to 24 who do not provide greater than half of their support from earned income. So if they are your dependent, then they do qualify for the Kiddie Tax Rules, or they are eligible for those. Now, after 2011, the first $950 of unearned income is tax-free. That's the student's standard deduction. The second $950 is taxed at the child's rate, which is pretty low. And then anything over $1,900 is taxed at the parent's rate, but the child is expected to pay that. So you want to see and understand the Kiddie Tax Rules to see if you could actually benefit from those, assuming all the other circumstances kind of fit, like we had talked about, especially with high-income earners. Now, the student's tax exemption, deductions, and credits, there is a personal exemption for a child, and typically that's claimed by mom and dad. I know we do that in our family. A lot of other families do as well. But there are situations where a student wants to claim independence. Maybe it's for financial aid purposes. Maybe it's for some other reason. But there is a support test for that personal exemption. And the support test for it is basically for whomever provides greater than half of the student support from income, assets, and then also student loans is included here too. So that's very important. So if the student is using his or her own assets and the income and the student loans to pay for more than half of the annualized cost of college, the student does pass the support test and can claim personal exemption on his or her taxes. So that's important if they're going to file that way for financial aid as well. The support test for the Kiddie Tax Rule then is that it's for the student that must provide greater than half of his or her support from earned income only. So again, very important. And then the American Opportunity Tax Credit, if the parents do not claim the student as a dependent and they do not claim the American Opportunity Tax Credit for the child, then the child can claim that for themselves. So again, it's a situation, unique situation, where mom and dad really aren't going to qualify for anything. Their income is too high. They don't get any of the tax credits. They're probably not getting any financial aid. So here's a way or an opportunity to get some tax breaks and then also possibly qualify for financial aid by shifting some of that over to your child. But again, don't do that unless you know it's going to benefit you, because it could be a penny-wise, pound-foolish type strategy if you go and put all these things in place and then find out that you just gave up tens of thousands of dollars in need-based financial aid in the process. So you need to understand both areas and make sure that this is appropriate for you and your family. So a couple action items. First of all, try to determine your need-based aid eligibility at specific schools as early as you can. And you want to make sure that you do that before you get into any specific tax planning strategies, because in some cases, the tax planning strategy can really shoot you in the foot for financial aid. So you want to look at both areas and see which direction is the best to take. And then once you have a better idea of the potential financial aid for your student, Evaluate your tax situation or meet with a qualified tax professional to evaluate the best tax planning strategy for your unique circumstances. And certainly don't base your decision solely on non-qualified advice from your friends or family members. And again, we see that happening all the time, that somebody's buddy down the street told them to do it a certain way, so they went ahead and did it. And what they don't know is that their buddy wasn't giving them all the information. They left something out that was a very different situation from their personal circumstances. So very important to talk to professionals that understand this if you're not doing it yourself. So if you are interested in taking a look at this and some of these considerations, feel free to give us a call. We do offer a free consultation. All it costs you is maybe 45 minutes to an hour of your time. You can check us out at our website at collegefc.com, or simply give us a call at 866-305-2321. It's our toll-free number. You can talk with one of our advisors and see if there's anything we can do to help. But at the very least, we'll certainly point you in the right direction so that you can do some planning yourself. One piece you might want to check out, we don't get into the financials as much here, but it does certainly support the school or college selection process and gives you a nice timeline, is one of our free opt-in reports called the Student Roadmap to Success. You can find this on our website. You do have to opt in for privacy reasons, but it is available there for you. We have some other free giveaways as well, reports and videos. And then here's our monthly newsletter, Planning News. You'll be opting into our newsletter. You'll get that by email on a monthly basis. You can unsubscribe anytime you like as well, but some really useful and good information that's updated monthly there. Here's a direct link to that particular page on our site. It's collegefc.com/newsletter. That'll take you right to that page where you can sign up. So thanks again for joining us on this video. Stay tuned for Part 7. And in Part 7, we'll cover how you can continue to fund your retirement savings while paying for your child's education. So we, again, thank you for joining us today, and we wish you the best of luck in the college planning process.